Now, as we pivot to the U.S. consumer, it's important to look at some of the pricing pieces of where things are right now. So new orders, less inventories predicting the ISM downturn, ISM manufacturing PMI composite, ISM new orders, less inventories, still showing that things are slowing. And that's, I think, common when you look at, just activity in general. But what is that going to do for prices at the ISM? As we saw earlier, we saw prices come down, and we want to look at that and layer it with, what are the expectations for inflation, which should realistically slow, but based on all of the underlying pieces on the bottom side, keep things fairly fixed in a downward trajectory. But again, the rate of change is not going to be as aggressive as some of these expectations. Household excess savings, when you look at some of the peaks, excess savings, when you look at personal savings continuing to draw down, continuing to pull out, the question is going to be, where is the excess savings? And as we've been saying, a lot of that is weighted towards the higher end of the spectrum. The top 20% of Americans still have those savings, but when you look at the bottom 80%, you've seen a lot of that get pulled out. And that's where we see the most pain, coming back full circle to what we talked about in segment 1, where you're seeing real wages negative. And again, that is a bigger hit for people in general. So U.S. real personal consumption expenditures, you can see it's holding the trend line. It's flatlining a bit, so you're not seeing too much of a change. We see that coming down a bit more for the December data, and then that is going to continue to slow into into January. U.S. real disposable personal income came in right around 15.1 trillion. So not too much of a change here. You can see we're still right where we were in 2019. And that's a positive when you think about, okay, well, they're still spending power is equivalently kind of the same. A lot of that capacity that was in personal income has been pushed to the market. A lot of that went into goods and a lot of these other movements, but that has since slowed. But it's being pivoted now to services, which is why even though we're seeing goods prices come down, you're seeing manufacturing come down, services is actually staying stronger and prices are going up. And for those that remember, when you compare that to sticky inflation versus flexible inflation, sticky inflation is really driven by service pricing, which again continues to move higher. Then when you look at U.S. real disposable personal income, you want to compare that to where we are right now in terms of the disposable personal income here. And just looking at the two charts together, just taking away some of the noise and just looking at it individually, you can see that there's still some of that pressure to the downside. But based on where wages are, where job openings are, it's not going down by much. So if a company can't cut wages and can't pull some of this money down, well, that becomes an issue because they have to pass on that price. They have to find a way to finance these individuals, and that's where you get some of the stickiness to some of the pricing sides. Now, when you look at the purchase only, and it's important to put this into context with housing, because hourly earnings have obviously gone up, but if you look at how home prices are in relative to income, there's still this parabolic move, and you can't risk letting wages go up because that could create a wage spiral. But you can't have home prices collapse because then you'll just put yourself into a much worse situation. So you're starting to get some of this balancing act in general, and you're starting to see some of the softness. And again, it's going to be a slow move, but there's still a ton of work to be done when you look at home prices. And that's why we still think home prices are going to continue to fall through this year and realistically continue to fall into 2024. Or they have to have wages go up. And again, I think there's, based on the commentary from the Fed in terms of housing, homes running hot, in terms of pricing, asset prices, also employment running still fairly strong, there has to be some of this adjustment. When you look at hourly earnings, weekly earnings, starting to see a bit of a rollover. This is coming from the source of paychecks, but it's still up. And going back to 2011, it's still fairly strong. And that's where there's some rollover, but we see this more of a balancing act here, not so much a huge collapse, but more of a sideways move at this point. So wholesale prices for eggs have surged. It's interesting, and again, tying this back into where we are on the medical side, eggs are used actually for the making of different vaccines. So we've killed the chickens that for either food or because of bird flu that make the eggs. So now you have a shortage of eggs, you have a shortage of chickens, and that's creating some of this inflationary moves, which is an interesting backdrop in general. So then when you look at manufacturing prices paid and CPI inflation, well, manufacturing has come down. It's still expanding, but obviously not to the level that it was. But when it's contracting at a fairly sizable level. But CPI, there's obviously downside movement, but service pricing is going to buffer some of that. As we showed with some of the leading indicators from the regional Fed data, you're getting some of that buffer with, again, that CPI inflation remaining a bit elevated. So then when you look at U.S. personal income, came in at 0.4 versus the estimate of 0.3. Prior was 0.7. Personal spending came in at 0.1 versus the estimate of 0.2. So the key to watch is real income, which rose in November and saw its 6-month annualized growth pick up to 1.7%. And it's a key reminder that this is one of the coincident economic indicators looked at by the NBER to determine whether we're in a recession. So that's where the conversation comes back to, are we in a recession? Well, yes and no. And that's where you get this pushback of, well, is it too early to say that we are? I say we are. And we're going to get that coming through because we do see a bigger drop in December than we got in November. And we think that accelerates in January, but they're still holding in. But when you look at the inventories on the retail side, you're looking at some of these overarching themes of a lot of inventory, not a lot of trade, and it just means that retail sales are slowing, and they had to do a lot of incentives to keep people purchasing. November new home sales came in at positive 5.8% versus the estimate of negative 5.1%. But then some of the leading indicators for December have showed this reversing. So again, we're just kind of a lot of things close in November just to get them closed. December will likely see a sizable drop as it normally does. So the level not too exciting one way or the other. Final read for December, University of Michigan consumer sentiment came in at 59.7 versus the prior 59.2. Expectations slightly better, but again, we're just kind of bouncing along the bottom, similar like we did in 2008. Gasoline prices are going to continue to come down. Diesel prices are going to continue to come down. That'll put some of that back up, but there's still a lot of overhang in general. So then when you look at service spending, still holding up. 6-month annualized growth came in at positive 3.6% in November, which is well off the peak, but still very firm. And service spending, again, that is that sticky inflation side buffering some of that contraction from the manufacturing front. November durable good orders came in at negative 2.1 versus the estimate of negative 1. So you're still seeing, again, durable goods just, again, kind of sideways. And that's what these back and forth pieces that we keep talking about that are showing some of the different pieces, because we saw what happened in December. December continued to slow down, but not this huge drop off. So this is where we get some of that buffering on the recessionary commentary. Then when we continue that forward and you look at personal income in comparison to personal savings, that's where as the personal income comes down, it's going to make savings as a percent of disposable personal income get worse. And that's where we see some of that continuation again to the downside. Personal November PC inflation came in at 0.1 versus the estimate of 0.1. And the core came in at 0.2 versus the estimate of 0.2. So you're still seeing fairly stable movements on a month-over-month basis. Again, not a change, but what we've been saying is that we just kind of flatline here and we see some of that sticky inflation. November PCE came in at negative 5.5 versus the estimate of negative 5.5. Core PC came in at 4.7 versus the estimate of 4.6. So again, some of that core piece, that's where we see some of this remaining sticky. Now, when we look at New Yorkers happier heading into holidays, consumer confidence for Empire State rose in December to the highest since November 2018, erasing all of the pandemic loss. While employment outlook continues to darken for Kansas City, December saw another move down in expectations for employment, but not yet contracting. So it's this bifurcation that you can get at different times in different regions, but the trend still continues to be to the downside, but obviously not fully to the downside. It's this slope that we keep talking about, or the depth of the recession. And there's some of those, again, overarching themes where it's not as bad as some of the other leading indicators are showing. Bidding war rate has fell to 40% in November. Bidders are just, when you look at it, home offers that face competition, at least one competing bid fell to 40% in November as housing market. It just means that you're only getting one bid. So you're either taking that bid and negotiating with them because there's no bidding wars. Those are over. And when you look at real home prices, they're just starting to crest, but it's still at the highs that it was in 2006, 2007. So even though it's rolled over, we're still at the highs the highest level we've been since 1976. So there's, again, on the real home price side, why we see more of this coming down, and we're going to see more pressure to the downside, which is a negative in terms of the trajectory for our employment growth, for our economic growth. Mortgage rates doubling from 3% to 6% disqualified 20 million households from a $400,000 mortgage and reduced the potential borrow pool by 40%, which, again, it just means less competition, less people available means less bidding wars, which, again, kind of supporting what we saw previously, with the Case-Shiller showing another decline, but the survey was for negative 1.1. The actual is negative 0.52. So you're seeing prices come down, but they're not coming down at the pace they need to or should, which is why we still see a lot of slowdown, and it's going to put a huge headwind on the economy going through the rest of 2023 and into 2024, because we see way more downside on the real estate front, on the housing front, and that it remains essentially an anchor that's going to pull the U.S. economy down, pull the consumer down. Because remember, the consumer spends based on not obviously what's in the bank, but also how, quote unquote, wealthy do they feel? Do they feel wealthy? And when your home prices are diminishing, that means you feel less wealthy, which means you spend less. And that's something that we think is going to be a common thread as we go through 2023. So that's what we have for you for the rest of the U.S. side. On the next front, we're going to look at Europe and give some updates before we go into the Asian markets.